Finance is built on a mathematical comfort blanket, the normal distribution. Modern portfolio theory assumes that risk and return cluster neatly around an average. Arizona State University professor Hendrik Bessenbinder analyzed the lifetime performance of nearly 26,000 U.S. stocks from 1926 to 2015. His data shows that the market does not follow a bell curve. This chart shows the actual distribution of stock market returns. Wealth creation is concentrated entirely on this extreme right tail. Just 90 companies generated half the net wealth over 90 years. The vast majority of the distribution is here on the left. Over half of all publicly traded companies actually destroyed value, resulting in $6 trillion in losses. Because the mathematics of the market are this severely skewed, targeting median returns is a mathematical error. Outperformance requires a system explicitly designed to find and hold those rare extreme outliers. Far from the financial noise of London, in the quiet streets of Edinburgh, sits an institution engineered entirely around capturing those outliers. Baillie Gifford has operated here for over 110 years. Over the last 20 years, their flagship Scottish Mortgage Investment Trust, or SMT, has delivered returns that expose the limits of traditional index investing. This graph tracks SMT's total return over a 20-year period. While the S&P 500 returned nearly 4 times its initial value, and the Nasdaq grew nearly 8 times, SMT delivered a 13.64 multiple on capital. This level of growth stands in direct contrast to classical value investing strategies, popularized by Warren Buffett and Charlie Munger, which rely on finding underpriced cash flows and waiting for mean reversion. The firm identifies nonlinear technological shifts by applying the principles of complex economics directly to individual stock selection. Their historical results suggest that capturing these shifts is the product of a systematic academic approach rather than standard qualitative stock picking. Classical economics operates on the principle of diminishing returns. As a factory produces more physical goods, the cost of raw materials or labor increases, and the market settles into an equilibrium. Economist Brian Arthur developed a different framework for the information age, increasing returns. In this model, the marginal cost curve flatlines. Software requires massive upfront capital for research, but once written, the cost to distribute the millionth copy is practically zero. Combined with user adoption, the product becomes more valuable the more people use it. This positive feedback loop is a network effect. These feedback loops defy market equilibrium. They create winner-takes-all monopolies that lock in an entire market. Microsoft spent $50 million developing Windows. But because additional copies cost pennies, Windows locked in the operating system market for an entire generation. Traditional discounted cash flow models fail here because they assume a company's growth will eventually stabilize into a predictable equilibrium. Tech monopolies are structurally designed to achieve permanent non-equilibrium dominance. Recognizing that the rules of production have changed is only the first step. Investors must separate companies experiencing ordinary cyclical growth from those driving transformational growth that rewrite standards. This is Carlotta Perez's model of the technological economic paradigm, mapping 4 phases: eruption, frenzy, synergy, and maturity. In frenzy, capital rushes in, creating speculation and a violent crash. But real wealth is generated in the synergy phase, as surviving technology becomes foundational infrastructure. Baillie Gifford's strategy relies on ignoring speculative noise, instead identifying the specific companies that will dictate the rules of the synergy phase. Compounding at this scale requires the discipline to maintain exposure through the transition from speculative frenzy into the long-term structural growth of the synergy phase. How does a portfolio manager actually spot a company experiencing increasing returns before the broader market prices it in? Baillie Gifford replaces standard quarterly metrics with a strict 10-question qualitative framework designed specifically to detect these deep structural shifts. Question 1 asks if the company's sales can double over the next 5 years. They prioritize exponential revenue growth and market capture over profit margins, recognizing that scale precedes profitability. Question 3 identifies sustainable competitive walls, screening for the academic concept of lock-in. Tesla's supercharger network provides a physical example. By establishing the dominant charging standard, Tesla forced a network effect that required competitors to adopt their interface, ceding control of the primary refueling infrastructure. Questions 8 and 9 examine capital allocation. The framework actively screens out companies paying dividends or buying back stock, as these actions signal a lack of internal growth opportunities. These questions operate as a specialized radar system. They are engineered to detect companies that reinvest every dollar of cash flow to accelerate their own positive feedback loops. Academic frameworks and strict screening criteria are mathematically useless if a portfolio manager panics and sells during a market crash. The companies that eventually deliver extreme returns routinely suffer massive interim losses. Baillie Gifford held Amazon through multiple catastrophic drops in share price. That requires immense conviction in the original thesis, extending far beyond the typical Wall Street holding period. Their structural advantage is that they operate as an unlimited liability partnership. Because there are no external shareholders to appease and no bonuses tied to short-term metrics, the partners are not incentivized to liquidate positions during a panic. In a standard Wall Street fund, a 40% drawdown usually guarantees the portfolio manager will be fired. Institutional patience is the absolute prerequisite for asymmetric returns. You cannot capture exponential, nonlinear growth if your career incentives are tied to linear quarterly metrics. To fight internal cognitive bias during these long holding periods, Baillie Gifford institutionalized the role of a devil's advocate, assigning someone specifically to attack the firm's own 10-year investment theses. They process market data through the military's OODA loop framework: observe, orient, decide, act, ensuring they are continuously adapting to real technological shifts rather than holding on to flawed assumptions. The tools of 20th century finance were built for an industrial economy of equilibrium and diminishing returns. They are inadequate for analyzing the monopolies of the 21st century. Successfully managing these assets requires a framework specifically calibrated for nonlinear returns. To capture the staggering wealth generated by technological monopolies, investors must abandon the safety of average market equilibriums and build frameworks exclusively designed to hunt and hold extreme asymmetry.